wasting much of our time. Good morning once again. So this is ACT 409 class. ACT 409 is Advanced Financial Accounting 2. So by God's grace, we try as much as possible to do study session 1 and 2 today. So I need your rapt attention, please. To start with, let me try to share my screen. If you can see my screen, please let me know. You can see my screen, please let me know.
It's very clear. We can see it right now.
Thank you. So I said it the other time. I said this is the 409 class, Advanced Financial Accounting 2. So we start with study session 1. That's a review of company accounts. It's all what we have already understood. So we won't spend much time as far as this study session 1 is concerned. So this is the structure of my presentation. So I have 3 learning outcomes. At the end of the day, you should be able to state the elements and the component of financial reports. So then we should be able to define and describe the characteristics of financial statements. How do we incorporate a company? So those are the 3 things that we need to do justice with. So let's start with the first learning outcome, which is the elements of the financial statements. Before we delved into the element of the financial statements, I said something when we are discussing financial reporting yesterday about financial statements. So financial statements shows you where a company's money came from, where it went, and where it is now. So that shows that as a user or the stakeholder, you may need a financial statement. So be able to know all these things I just mentioned. So as a user of financial reports, you need financial statement to make an informed decision about a particular company, whether to continue to invest with the company or to stop investing with the company. So now, after we might have understood what the financial statement is all about, so the next line of action is what are the elements that we can find in the financial statement. So if you look at the financial statements, we have 3 contents that are very germane, that are very important, but 2 out of the content is what we are interested in. So the first content is a statement of financial position, while the second content is a statement of profit or loss and other comprehensive income. So though we have other contents, which are statement of changes in equity, and statement cash flow statements, and accounting policy and explanatory notes. So with this now, so the element that we are talking about should be based on the statement of income. So International Financial Reporting Standard define a general purpose financial statement. What exactly do I mean by general purpose financial statement? So a general purpose financial statement is a financial statement that comprise a minimum content of the report. That is, when you see a general purpose financial statement, you should be able to address some content, at least minimum content, which I just mentioned: statement of financial position, statement of profit or loss and other comprehensive income, statement of cash flow, a statement of changes in equity, and explanatory notes. So those are the minimum requirements that we must find in the general purpose financial statement. International Financial Reporting Standard, IFRS, set out conceptual framework for financial reporting in private enterprises and public sector business enterprises. That shows that the general purpose financial statement can be found in private enterprises as well as what public sector business enterprise. Don't forget, I made mention of SMEs yesterday, but the IFRS for SME has to be what specific. It doesn't need to be what to be a generalized IFRS. So now let us now look at what the general purpose financial statement means in our material. So the conceptual framework form the basis for the preparation of general purpose financial statement. What we mean by general purpose financial statement is that when you have a financial statement, which is general purpose, that is, it must contain or comprise of every information that the users or the stakeholders that they need from that particular financial statement. For instance, a user is interested in how the asset is being utilized. So a general purpose financial statement must contain an element, or let me say content, that will show how the asset has been utilized by the company. In another sense, a users may be able to look at how exactly the organization is being faring, in the sense that whether the organization is making profit or not. Do you understand? So automatically, an organization must try as much as possible to provide a content that will show the profit or loss of that particular organization. That shows that the users is interested in a profit or loss, another comprehensive income of an organization. So that's exactly what we mean by what general purpose financial statement. So now, what are the elements that we can find in the financial statement? So this can be grouped into two. I said we have three major content of what the financial statement. We have statement of financial position, we have statement of profit or loss, another comprehensive income, and we have statement of changes in equity. Do you understand? So two out of these contents are very, very germane for every organization. The first one is what? Statement of profit or loss, another comprehensive income, and statement of what? Financial position. So every interested users must be able to lay his or her hand on what? On statement of financial position, to look at whether the asset is being utilized properly. Do you understand? So how the liability has been what? Incurred. Do you understand? So those are the things that you must find what? In the statement of what? Financial position. I gave you an equation yesterday about the accounting equation that says asset is equal to equity plus what? Liability. Asset is equal to equity plus what? Liability. Those three elements can be found in the statement of what? Financial position. Assets, liability, and equity. Let me quickly try to explain what assets, equity, and liability simply means. When you have assets is the resources controlled by an entity as a result of past events in which future economic benefit will flow to the entity. That's according to conceptual framework. That's the definition given by what? Conceptual framework. What do I mean by assets? Look at this building, for instance. This is the asset of the university. This particular building is the asset of what? University, because this building is a resources in which the control of this building is in the hand of the what? The university management. That shows that this building has generated a lot of revenues for what? For the institutions. They are the resources that are in which future economic benefit will flow to the entity. So it's generating a lot of revenue to the what? To the institution. So that's what we mean by what? Assets. Assets can be understood better when you categorize it into two. The first one is non-current assets that span for a very long time, maybe 3, 4, 5 years and more than that. So we have fixed assets which span for a period of what? 1 year, within 1 year. For instance, cash out and cash out bank, inventory. Do you understand? So those are the current assets. But non-current assets can be better understood using IS16, that is property, plant, and equipment. When you are talking about non-current assets, just put your mind into what? IS16, that is property, plant, and equipment. So when we get to IS 40, so that is that talks about investment property. So still talk about these non-current assets. So now that's that about what? About assets. The liability aspect of the element that we can find in the statement of what? Financial position. So when you are talking about liability, liabilities is a present obligation, is an obligation. When you say something is an obligation, do you understand? So it's a present obligation as a result of past events in which future economic benefits will flow out of the entity. So it's an obligation in the sense that the instead of the resource to be flow to the entity, the resource will not be what? Flow out of the entity. Whatever you generated from the liability is going to the what? To the owners of the liability. For instance, when you acquire this building, you got a loan from bank. Do you understand? You use that loan to erect this building. Do you understand? So after which, whatever this building is generating, instead of the benefits to be flow to what? To the entity, it will now be flow to what? To the party that what? That borrowed you the money. So that is the reason why we said it is the resources which is also is a present obligation, which is also controlled by what? By the entity. But as a result of past events, but the revenue generated from the liability is flowing out of what? The entity. So it's not the benefit for the entity, but for the what? For the person that borrowed the borrowers the money. That's why you see when you borrow money, you pay the principal and you pay the interest. Principal is the original amount borrowed. Then the interest is the sum attached to what? To the amount borrowed. So that's that about the liability aspect. Then let's quickly talk about the equity. Equity is the residual interest after the asset has been taken, after the liability has been taken care from the assets. Let me give you a quick calculation of this. Let's assume we have this assets is equal to liability plus equity. So you can see now I've defined assets, I've defined liability. Then for equity now, I can as well say assets minus liability equals equity. Equals equity. You can see. So I've made the equity to be the subject of the formula. So automatically, the implication is that this equity simply means the residual interest after liability has been taken care of from the asset. After you might have deducted your liability from the asset, whatever that remains is what? Is your equity. That's exactly what we mean by what? Equity. All these elements now, asset, liability, and equity can be found in the statement of what? Financial position. So that is that about the element that you can find in the statement of what? Financial position. So now the remaining two elements, that is revenue and expenses, can be found in the what? In the statement of profit or loss and other comprehensive income. That is why when you are doing your profit or loss account, so we have your revenue minus our expenses, so to be equals to profit before tax. Exactly. So to be equals to profit before tax. The implication is that we have not included tax here. So immediately you included tax, it will now be your profit before tax less your tax, it says. So for corporate companies, 30%. So it will now be equals to profit after tax. So that is that about. So the two elements that can be found in the statement of profit or loss and other comprehensive income are just two. That is revenue and what? And expenses. Why the element that can be found in statement of financial position? There are three. That is assets, liability, and equity. So that is that about the elements of financial statements. So now let us move to the qualitative characteristics of financial statements. So when you are talking about qualitative characteristics of financial statements, do you understand? So what are the attributes that the financial statement must have for us to place our reliance on it? That's what we mean by what? Qualitative characteristics of financial statements. So these qualitative characteristics of financial statements are divided into two. We have fundamental qualitative characteristics of financial statements, and we have what? Enhancing qualitative characteristics of financial statements. So when we are talking about fundamental qualitative characteristics of financial statements, we're talking about the relevance and what? And the faithful representation. Relevant and what? And the faithful representation. But when we are talking about enhancing qualitative characteristics of financial statements, we'll be talking about comparability, timeliness, verifiability, materiality, and understandability. But majorly in enhancing qualitative characteristics, we have comparability, verifiability, timeliness, and understanding. Materiality is part of what affects the faithful relevance or faithful representation of what? Of the financial statement. Let me quickly explain all these qualitative characteristics of financial statements. So when you are talking about relevance, information is said to be relevant if it will assist users to evaluate performance and position of an organization. What we mean by performance and position in terms of what? Profit or loss and other comprehensive income, and statement of what? Financial position. So any information that is relevant, it will assist users for them to be able to evaluate the performance of that particular organization in terms of what? Looking at the profit or loss account of the organization, or in terms of position, looking at what? Statement of financial position of that particular organization. Another interesting thing about the relevance is that relevant information should be capable of making a difference in the reporting, in the financial reporting of an organization. So what we mean by making a difference is that if you can be able to compare the financial statements of a particular organization to that of another organization, you can see that you have made a difference. That shows that that particular financial statement is relevant. So that is that about being relevant. So under relevance, the relevance of information is affected by two things. The first one is the nature and the materiality of the information. The nature and what? Materiality of the information. When we say that the information is material, if it's omission, any information that is material simply means that if it's omission or misstatement can influence the decision of what? Of the users. So that's what when we say the information is what? Is materials. Any information that cannot assist or that cannot influence the decision making of a user, that information is not what? Is not material. Only material information is what? Is recorded. So that's the rule of thumb. So let's quickly talk about faithful representation. This means that the financial statements of every organization should be prepared and presented to represent or reflect faithfully. Do you understand? So it must reflect faithfully or truly the financial transaction of that particular what? Of that particular organization. Any information that represents faithfully or truly represent the financial transaction of that particular organization, we can say that that information is what? Is a faithful representation of a particular organization. So that is, let's assume we have an information like this. So, and that particular information faithfully represents the clear image or picture of that particular organization. You can say that there's a faithful representation of that particular report. Then when we are talking about enhancing qualitative characteristics of financial statements, so we'll be talking about comparability, verifiability, timeliness, and what? And understandability. So what I mean by comparability is that a financial statement should be able to be comparable in the sense that when you have a financial statement of a particular organization and a financial statement of another organization, you should be able to compare in terms of the profit or loss of that particular or of the two companies, in terms of how their asset has been utilized, in terms of how the liability has been incurred. Do you understand? So then what was the interest? What was the residual interest after the asset has been taken, after the liability has been taken care of from the asset? So those are the things that you should be able to compare. So then you should be able to compare the performance of an organization over years. for instance, when you look at a financial report of a company for 2022, for instance, so in that particular report, they will give you a report of 2021. That shows that you should be able to compare the report of 2022 to the report of 2021. If there's a progress, you know, because from their results, this is profit after profit for the year in 2021, and this is profit for the year in 2022. So you should be able to compare, oh, this particular organization is making progress. Do you understand? So you look at their assets, look at their liabilities and some other things. So we'll be able to compare the progress of that particular organization. Then verifiability, you should be able to verify an information. That is why before you can place reliance on a financial statement, that financial statement must be verifiable by an external party called external auditor. That is why you see in every financial report, you look at the auditor's comments, they will say, to the best of their knowledge and in their own opinion, the report of these social organizations gives a true and fair view of Johnson. That is what they are trying to say is that they have scanned through all the figures, they have scanned through all the elements, everything is in line. So the basis used, they are in conformity with what the IFRS is saying. Do you understand? So those are the things that the external auditor will look at. So having certified the report, they will now give their own objective opinion. So that is the reason why every financial statement has to be verified. Then timeliness. So timeliness is an important aspect of enhancing qualitative characteristics of financial statements. So every financial statement must be time scaled. You know, the financial statements should be produced every year, most especially at the year end. Do you understand? So any financial information that is not timing automatically is not a good financial information again, because time is a very important aspect of every financial report. That about timeliness. Then we have understandability. Understandability in the sense that every financial information given must be understandable. The information therein must not be must not be ambiguous to the extent that the users will find it difficult to read or to understand the content therein. So automatically, every financial statement should be right in a clear and concise manner to the extent that the language used in that particular financial statement must be clear, must be concise, and must be simple. So that is why we say the financial statements has an enhanced qualitative characteristics. So document of, that's the third learning outcomes, document of incorporation. So what do I mean by incorporation? Incorporation simply means when you want to register a company so that the company will have benefit to some certain things. Do you understand? So documents, what are the documents that you put together for you to be for you to get incorporated? So these are memorandum of association and articles of association. The notice to the address of the registered office of the company, that is where you want to situate the company to. Different from this different from the registered office or postal box address or private mailbox. So statement of the list or consent or particular of first directors. So the first directors of that particular organization should be provided as well. Statement of the authorized share capital of the company, which must be at least a director. Then a statutory declaration of by a legal practitioner that the requirement of CAMA, that is Company Matter Act, regarding company incorporation have been complied with. Then finally, any other document required to satisfy the requirement of any law relating to the formation of the company should also be provided. So these are the incorporation documents that we need to file with the Corporate Affairs Commission. Then mandatory incorporation. Company or association or partnerships more than 20% is illegal to operate in Nigeria unless registered under 2004 LFN. That is for a company or association or partnership, which is more than 20 persons, to operate in Nigeria without being incorporated is an illegal business. So there's a mandatory incorporation for any group of persons formed with the aim of what? Making profit or gain. And any such organization that is not incorporated is illegal. So if you have a particular company in which it is deemed to be an incorporated company, so you must register such a company. So otherwise, you are running an illegal business. So if you look at some cases, we have some cases in this our slide. So Akinloshe and others versus AIT and others, 1961 to 15. The association was being managed by over 100 members. Look at the company. It's been managed by 100 members, and it was not registered at all. So this is a kind of illegal business that you're talking about. So Section 19, subsection 2 permitted 3 exceptions to this rule. Where the association is a registered cooperative society, it need not to be incorporated. If it's a registered society, registered cooperative society, there is no need for them to be incorporated, like what we have all this cooperative society. Any partnership formed for the purpose of carrying on practice as legal practitioner by person, each of whom are legal practitioners, the law permits more than 20 of them to form a partnership for the purpose of their work profession. Then any partnership formed for the purpose of carrying on practice as accountant by person, each of whom is entitled by law to practice as an accountant in Nigeria. So those are the exceptional cases that we are talking about. Thank you and God bless you. That's for study session 1. So let's quickly move to study session 2 before questions and answer session. So in this study session 2, this is where the business are started. So let's start with this. So this is the structure of my presentation. So the business proper. Let me just give you a brief overview. Okay, I've even done that before. So this particular course is talking about group accounts. So that's the main reasons why we are here, group accounts. So then the second learning outcome is preparation of consolidated statement of financial position. Then preparation of consolidated statement of income, that is profit or loss and other comprehensive income statement. Then elimination of intergroup balances. So if there's a group transactions between the parent and the subsidiary, so that's what we are talking about. So let's quickly move to the first one. That is the first learning outcomes. So when we are talking about group, what comes to our mind? So group simply means consolidation. So that's why it is synonymous with consolidation. When you consolidate something together. So that's what we mean by group. Do you understand? So these are the financial statements of a group presented as a single economic entity. So that is when you are now talking about a group financial statement. So you'll be talking about the financial system of a group now presented as a single economic entity. For instance, you know, we have United Bank for Africa, and UBA have several branches. Do you understand? So there should be an head office, do you understand, which act as a parent, while other branches will act as what? Subsidiaries. So when we now consolidate all the accounts together and presented it as one, that's what we mean by group financial statement. So then let us quickly move to the regulatory body or document for group account. Matter Act Cap 20 LFN 2004, later called the Acts. That's the first regulatory document that we need to look into anytime we want to talk about the group account. Then IS27 consolidated and separate financial statements. Then IS28 investment in associates. Then IS31 interest in joint ventures. Then IFRS 3 business combination. Then IFRS 10 consolidated financial statement. Then IFRS 10 replaces the portion of IS27. So you can see what I said yesterday. So some of the standard international accounting standard has been replaced by the IFRS. So some portion of IS27 has been replaced by IFRS 10. Do you understand? So then we have IFRS 11 joint arrangements. IFRS 11 also replaces IS31, that's interest in joint ventures, and SIC 13, that's jointly controlled entity, that's monetary contribution by ventures. Then SIC 12, that's consolidation, special purpose entity. Then we have IFRS 12, disclosure of interest in other entities. Then IFRS 12 includes all of the disclosures that were previously in IS27 related to consolidated financial statement as well. So what we are saying here is that if I were you, IFRS 12 and IFRS 10 covers almost everything in IS27. So we don't need to bother ourselves reading IS27 again. So since we have seen a standard that covers IS27, because IFRS 10, that is International Financial Reporting Standard, that talks about consolidated financial statement, have replaced major portion of what IS27. Then IFRS 12 that talks about disclosure of interest in other entities have also replaced IS27. So there's no need to bother ourselves as regards IS27 again. So those are the regulatory documents that we need to understand as far as the group account is concerned. Then the next question is, what is a group? So a group is defined as a parent and its subsidiaries. A group is defined as what? A parent and its subsidiary. That can be likened to parents and what? And the children. Do you understand? So if we want to present something, the parent can present it as if the parent and the children are one. That's what we mean. So group financial statement are the financial statement of the parent company and its subsidiary combined to form a set of what? Consolidated financial statement. The financial statement will appear as if it's just a one entity, whereas the parent and the subsidiary, parent is one and subsidiary are many. So when you now merge all the accounts together and present it as if it is just in one single document, that's what we mean by group accounts. So in accordance with the Act, when we mean what I mean by the Act is Company Alignment Act 2004. The group financial statement shall consist of 3 statements as follows. We have consolidated statement of financial position dealing with the state of affairs of the company and all of the subsidiaries. That is where we'll be talking about the assets, the liability, and the equity of that particular company. Then we have the consolidated income statement that talks about the profit or loss. Do you understand? How the organization makes its profit, do you understand, or loss? So then we'll be talking about consolidated statement of cash flow of the company and its subsidiary. So then consolidated statement of what? Changes in the equity of the company and its subsidiary. And note to the consolidated statement of financial position or statement of profit or loss and other comprehensive income. So what we are saying here is that when we are talking about financial statement, ordinary financial statement, I said there are some minimum content that we must follow. Do you understand? Or there are some minimum content that the users or the stakeholder will look into, like statement of financial position, statement of profit or loss and other comprehensive income, cash flow statements, then statement of changes in equity, then explanatory note. Those are the minimum. So what we just need to do as far as group is concerned is that we just added what? Consolidated statement to it. When you now add consolidated statement to it, you now be consolidated income statement, consolidated statement of financial position, consolidated cash flow statement, consolidated statement of changes in equity, and etc. Right. So then we'll be talking about the parent and the subsidiary. So the parent and what? The subsidiary. So when you're talking about parents, you'll be talking about holding company. A parent company is also known as what? Holding company. So it's a synonymous terms. So then when you are talking about the subsidiary, you'll be talking about an enterprise that is controlled by another enterprise. That's why I made mention of the parent and the children, for instance. Parent is one that has one or more children. Rather. Parent is one that has one or more children. So that is parent. So why the subsidiary is a child that is controlled by another enterprise. That is, we'll be talking about what? The parent. So now, when we are now want to explain the holding company and a subsidiary company now, we'll be talking about a holding company, which is a parent company, is one that has one or more subsidiaries. Very clear. That has what? One or more subsidiaries. While a subsidiary itself is an enterprise that is controlled by another enterprise known as the parent. So it is the parent that controls the subsidiary. So parent subsidiary is a function of what? Of the parent. That is, without a parent, there won't be any subsidiary. So now, under section 338 of the Act, a company, say, let's say company A, shall be deemed to be the subsidiary of another company, say company B. A company B is a member of it and controls the composition of its board of directors. Or two, holds more than half the nominal value of its equity share capital. Or three, the first mentioned company, that is company A, is a subsidiary of any company which is a subsidiary of what? Company B. What they are saying here is that if we want to say that a subsidiary company, a particular company is a subsidiary of another company. So that is, we must have this. It must control the composition of its board of directors. It must hold more than half of the nominal value of the equity share capital. Then it must be a subsidiary of another company. So control and significant influence without company. Because when we are talking about parent and subsidiary, we will be looking into the control and what? And the significant influence. That is, if I say a particular company is controlled by another company, so what does that mean? So we'll be talking about control throughout this course and the significant influence. IFRS 10 talks about the financial statement. So, and this IFRS 10 establishes a single control model that applies to all entities, including special purpose entity or structured entities or variable interest entities. So the changes introduced by IFRS 10 will require management to exercise significant judgment to determine which entities are controlled and therefore are required to be consolidated by a parent compared with the requirements that were in IAS 27. So now, when we now talk about the control, this is the ability to govern the financial and operating policy of an entity according to IFRS 10. So generally, control is also presumed to exist when the parent has power over more than half the voting rights, power to govern the financial and operating policy of the enterprise under statute or agreement, then power to appoint or remove the majority of the members of the board of directors, then power to cast the majority of votes at a meeting of board of directors or equivalent governing body, and control of the entity is by that board or body. So that is why we can say that control has existed. So let us talk about the methods of preparing consolidated financial statements. Method of preparing consolidated financial statements. Before IFRS 3, that's business combination. So IFRS 3 talks about business combination. There are two main methods of preparing consolidated statements: the purchase method and the pooling of interest method. Those are the two methods before IFRS 3. So IFRS 3 now allows only the purchase method. So that's the essence of all these international financial reporting standards. We have to be conversant with all these IFRS. Before now, we'll be talking about these two main methods. That is purchase method and pooling of interest method. But when IFRS 3 comes into play, so it abolishes the pooling of interest method and make the purchase method to be in operation. So under the purchase method, these are the features. One, asset and liability of the subsidiary are measured at fair market value at the date of acquisition. So look at that statement. Assets and liability of the subsidiary are measured at what? Fair market value. So fair market value. Fair market value, fair value measurement is discussed under IFRS 13. Fair value measurement. That is, what we mean by fair value is that both the willing parties, both the buyers and the sellers, they must have had an agreement before a transaction can be taking place. Do you understand? So now, share purchased and issued in settlement of the purchase are valued by the parent company at fair value. Share purchase must be valued by what? Parent company at fair value. The profit of the subsidiary are divided into pre-acquisition and post-acquisition period. What we mean by pre-acquisition, before the acquisition is taking place. So post-acquisition is after the acquisition has been taking place. You will see all this merger of intent that comes within all these banking sectors. We have an intercontinental merge with Access, UBA merge with Standard Trust Bank, and etc. So the profit of the subsidiary are divided into pre-acquisition and post-acquisition period. Only post-acquisition profit should be consolidated. That's the word. That's the key word. So once you have divided your profit into two, pre-acquisition profit and post-acquisition profit, forget about pre-acquisition profit. It is the post-acquisition profit that will be taken into consolidated statement. So that is the reason why you need all these following method of what? Purchase method. Then goodwill arises on consideration when the fair value of the consideration is different from the fair value of the net asset acquired. So I will explain how to calculate the goodwill. But what this one is trying to say is that when the fair value of consideration, that is what we mean by consideration is the cost of investment. When the fair value of the cost of investment is greater than the net asset that has been acquired by the company, automatically we have positive goodwill, or what we can term as what? Goodwill. Otherwise, we have what? Bargain purchase. So then the next thing here is requirement of IFRS 3 in relation to acquisition method. Now, what we are saying here is that let us look at how to arrive at what? At goodwill. So that's what this one is talking about. So the first thing that you do is you first of all identify the acquirer. Who is the person that acquire another company? You identify the acquirer, then you determine the acquisition date, the date of acquisition, because the date of acquisition is very, very important. So once you have determined the date of acquisition, you'll be able to know what happens before what? Before acquisition. Do you understand? You'll be able to know what happens before acquisition. Then another thing here is that recognize and measure identifiable asset acquired and the liability that has been assumed at the fair value date. So you recognize the assets and you recognize and you assume the liability at what? At the fair value market date. So then the next one is NCI. You calculate your NCI. That's non-controlling interest. This non-controlling interest is talking about the minority interest. Let me give you an instance. Let's assume a particular company using 80% of the net assets or 80% of the shares. So the action is taking place between A and what? And B. So the remaining 20% is for the outsiders. It's not within the control of the two companies. Do you understand? So that's what we mean by non-controlling interest. So fair value or proportionate share. So to calculate NCI, it's either you use fair value or proportionate share. Then you recognize and measure your goodwill. Once you have recognized and you measure your goodwill, so you have calculated the goodwill. And don't forget, if the fair value of the purchase consideration, that is the cost of investment, is greater than the net asset acquired, automatically you have what? Positive goodwill. Otherwise, if the purchase consideration, that is the cost of investment, is less than the net asset acquired, you have what? Bargain purchase, which can be termed as what? Negative goodwill. So IFRS 3, that's continuation. So IFRS 3 introduces restriction on the expenses that can form part of the acquisition cost. So there should be a restriction on the expenses. So there are new principles for the treatment of contingent consideration. This should be explained under IS 38. So when we get there, we try to explain more. Then a choice in the measurement of non-controlling interest. Then considerable guidance on recognizing and measuring the identifiable assets and assume liability of the acquired subsidiary. So the acquisition cost. What do you mean by acquisition cost? All acquisition costs, even those directly related to the acquisition, such as professional fees, legal, accounting, valuation, etc., must be expensed. So cost of acquiring a particular company, that's what we mean by acquisition cost. So if company A acquire company B at a certain amount, do you understand? That amount is an acquisition cost. And this acquisition cost that we are talking about must be expensed in line with revised IFRS 3. Do you understand? So an acquisition that cost that we are talking about can be legal, accounting, and valuation cost. Then contingent consideration. IFRS 3 defines contingent consideration as an obligation of the acquirer to transfer additional assets or equity interest to the former owners of an acquiree as part of the exchange for control of the acquiree if specified future events occur or conditions are met. If all the conditions are met, automatically the obligation of the acquirer to transfer additional asset or equity to the former owners of an acquiree as part of the exchange for control will be what? Will be in existence. So that's exactly what we mean by the revised IFRS 3. So then contingent consideration classified as equity shall not be remeasured, and its subsequent settlement shall be accounted for within equity. The same way we account for non-controlling interest, that's the same way we account for contingent consideration. That is, we credit share capital or share premium account, and we debit the retained earnings account. So contingent consideration classified as an asset or liability that is a financial instrument and is within the scope of IS 39, that's financial instrument, shall be measured at fair value with any resulting gain or loss recognized either in statement of profit or loss or in other comprehensive income in accordance with that of IFRS 7 and 9. So then, if it's not within the scope of IS 39, shall be accounted for in accordance with IS 37, that is provisions, contingent liability, contingent asset, or other IFRS as appropriate. So then let's talk about the goodwill and non-controlling interest. So we've discussed what goodwill is all about before. The acquirer, that is a parent company, measures any controlling interest either at fair value as determined by the director of the acquiring company, often called the full goodwill method, you can see, or at non-controlling interest, that's as a proportionate method, share of the acquiring. You just look at the proportionate share of the acquiring, that is subsidiary, identifiable net assets. Although this is the method that they normally use in UK. So the differential effect of the two methods is that it recognizes the whole of the goodwill attributable to an acquired subsidiary, whereas only recognize the second one is only recognize the parent share of the what of the goodwill. So this is the examples, the solution has been given in the manual. So in the next lecture, there is a video that I've done a little calculation of this, so I will share it after the lecture. Then IFRS 10, that's classification of contingent consideration. IFRS 10 states that a parent entity is allowed not to present or prepare consolidated financial statement if certain conditions prevail. If it's a wholly owned subsidiary or is partially owned subsidiary of another entity, and all its other owners, including those not otherwise entitled to vote, have been informed about. Then, and do not object to the parent not presenting consolidated financial statement, its debts or equity instrument are not traded in the public market. That is, if its debt or instrument, that's financial instrument, are not traded in the public market, you are not, a parent entity is not allowed to present or prepare consolidated financial statement. Then another one, if it did not file, nor is in the process of filing, so the parent cannot be prepared or present consolidated financial statement. Then if it's financial statement with a security commission or other regulatory organizations for the purpose of issuing any class of instrument in a public market. And finally, if it's ultimate or any intermediate parent produces consolidated financial statements that are available for public use and comply with IFRS. So it should not present, the parent should not present or prepare the consolidated financial statement in this regard as well. So what are the objectives of International Accounting Standard Board? I've explained this thing in our financial reporting. So when we are talking about group accounts, so we try as much as possible to explore all the IFRS. So before we can reach a particular conclusion that we needed. So the objective of the body regulated International Financial Reporting Standard, that's ISB, one, to formulate and publish in the public interest accounting standard to be observed in the presentation of financial statements and to promote their worldwide acceptance and observance. So to work generally for the improvement and harmonization of regulations, accounting standard procedures and related to the presentation of financial statement. So those are the things that we need to achieve as far as International Accounting Standard Board is concerned. So now, these are the ways to produce a standard. So there should be a steering committee. So chaired by representatives, usually including of at least 3 other countries. You understand? At least 3 other countries. At least we have 10 countries that started this harmonization of a thing. So UK, Ireland, US, Germany, Japan, and some other countries. So the steering committee identify and review all the accounting issues as with the topic. That's what I said yesterday. So once a topic has been chosen, do you understand? Once a topic has been chosen, they have to what? They have to look at all the accounting issues that relates to that particular topic. So the steering committee then submit a point outline to the board. So once you have done that, they will now submit a point outline to the board. After receiving the comment from the board, so the steering committee prepares and publishes an exposure draft. That's why I said at least 3 months was given to them to observe their own comments. So the next stage is the preparation of final stage of principles, which is submitted by the board, by steering committee. So the final statement is usually as the basis for preparing an exposure draft of a proposed IFRS. So the steering committee prepares an exposure for approval by the board. So then the steering committee reviews the comment and prepares a draft IFRS for review by what? By the board. During the process, the board may decide to issue a discussion paper for comment or to issue more than one exposure draft. This is a comprehensive way of producing a particular standard. So I made mention of some things yesterday. So before a high quality or enforceable or global IFRS should be produced, these are the people that are involved. So ISC Foundation, so it has changed to ISB, don't forget. So this ISB, we have advisory committee and we have interpretation committee. So that is that. I've explained that one. So there's no need to disturb ourselves. So this is IS. We have IS 41. So and we have 16 IFRS. So I will share you the IFRS and IS that we have now. So and I even put it in your learning management system, so you'll be able to see them and master them appropriately. So this is the list of. So now let me share the screen. Hello, can you hear me, please?
Yes, sir. We can hear you, sir.
Yes, sir. We can hear you, sir.
So this
Yes,
is
sir. We can hear you, sir.
so this is for statement of accounting standard. So this is for IS. We have IS 41. So then this is for IFRS. So now, have you seen it? So we have 16. So I need to update this self. So this is just 30 IFRS, but we have 16 IFRS now. Do you understand? So this is just 12. So, but you can do with this one for now. So this is IS, National Accounting Standard. We have 41. So although some of this standard has been replaced by IFRS, do you understand? So those are the things that you need to know as far as the first and the second study session are concerned. So if there's any questions, suggestions, comments before we call it a day, please do so. Thank you.
Good afternoon, sir.
Good afternoon.
Yeah, so this your PowerPoint. I hope you will give us so that we can study it. Most of the
Of
last
course, I
lecture we
will.
had, you promised you will give us. We want to start studying.
Yes, of course, I will. I will.
How
I will.
often will it be, sir? I hope we can get it by weekend, sir. We really need it. You know,
No,
we have to start
you will
reading.
get it today by God grace.
Thank you very much, sir. Thank you, sir.
Any other question? So you can check your, what is it called? Check your Zoom now. I've sent the PDF, what is it called? The PowerPoint and the PDF. Have you seen it?
Yes, sir. Thank you, sir. I've seen it.
Okay.
On WhatsApp, Baba?
No,
WhatsApp or Zoom, sir?
Zoom.
Zoom?
I just send it now.
Go to chat. You will see it there.
Okay. Can we download it?
Yes, you can download
Click on it. I've downloaded it. You can download.
Okay, thank you.
So you can share it to your group for others to see.
Okay, sir. I will do so.
So in the absence of questions, suggestions, comments, I think we can call it a day. Bye-bye. Take good care of yourself.
Hold on,
do
don't
the
end
next
so
class.
that I can download. So it's 3.
Yes.
Yes, it's 3. I will send it now. Yeah.
Okay. Thank you, sir. Thank you so much, sir.
Thank you. God bless
Thank you,
you.
sir. All right, sir. Bye.
Okay. Bye-bye.